You're entering the future-ready CNBC TV18 EBIX Cash Studio.
Hello and welcome to the CNBC TV18 EBIX Cash Studio. I'm Sumaira Abdi and you're watching MF Corner. On the show today, we're going to be answering viewers' queries which have come in to us, and joining in will be Anand Dalmia, co-founder and chief business officer at Fisdom, and Harshvardhan Roongta, CFP at Roongta Securities. So gentlemen, thank you very much for joining in and for answering the queries sent in by our viewers. The first question that we have coming in has come in from Twitter. So Mukul has posted this query on Twitter and he wants to know why the sovereign gold bonds mostly trade below their issue price and why RBI keeps rolling out new series when one can buy the previous ones at a discount in the secondary market. Good question, Mukul. Anand?
Yep. So, sovereign gold bonds, as we know, was introduced by the government a few years back because of the love of Indians for the, yellow metal. So rather than, they buying physical gold, RBI created sovereign gold bonds so that we can invest in gold, digitally and convert it into financial savings. So you get a lot of benefits like, the tax is free if you hold till maturity. There is a interest on your holding. But the price of the bond is linked to the underlying international gold prices. So whether it's up or down, it actually depends on the price of the gold. The last series which came out, if you look at it today, because gold has rallied in the last month or so, you see it's at a premium. So the premium or the discount is linked to the underlying gold prices, and it's not dependent that after buying it will go down or it has to go down. The second part, why do they keep coming out with more and more series when existing is trading at a discount? I would say, firstly, existing does not trade at a discount. Only for demat holders, you can go and sell, your SGBs, as they are called, before the maturity period, which is 5 years or 8 years. But, it's not so liquid. So there's a small discount besides the price because of liquidity. The government keeps coming out because there is a huge demand for it and people want to hold it for a long period of time. So I would say sovereign gold bond for retail investors is not a trading product. It's actually a long-term investment product. So, one should buy it and hold till maturity. You'll get interests. You will get the appreciation if gold appreciates. And there will be no tax if you were to make money at the end of 8 years.
Okay, so Mukul, I hope you were listening and you've got your answer from Anand. The next query comes to us from Dr. Prahlad, who has also written to us on Twitter. He wants to know how investors can get same-day NAV in mutual funds. But before that, Harsh, I want to know, what have you done to your hand?
Sumaira, I just, while playing a sport, I fell down and kind of have a shoulder blade dislocation. It's much better now.
Okay, yeah, so speedy recovery to you. And I hope you get back to your sport soon. But anyway, to answer Dr. Prahlad's question now, what's the best way to get the same-day NAV?
Sumaira, if you see from effective 1st February 2021, the rules for getting the same-day NAV have been changed. Now, what does it say? So an investor will get the same-day NAV only if the fund house receives the money before the cutoff time. So, and the cutoff time being 3 p.m. So the difference being, earlier where you could punch a transaction, a purchase request before 3 o'clock, here the rules have been tweaked to say the money needs to get into the fund house's account before 3 p.m. Now, only in case of overnight funds and liquid funds, if we're talking about, the cutoff time is 1:30. So in case if the fund house receives the money before 1:30, you in fact get a previous day's NAV. And if it comes into the fund house after 1:30, you get the same day NAV. Now, what needs to be kept in mind by an investor, it's not that merely you punched in a purchase request before 3 o'clock, or even if the money gets debited from your bank account before 3 o'clock, does not mean it has automatically reached the fund house's account before 3 p.m. More particularly in case you're using a third-party platform. So in case you're using, say, a BSE or an NSE mutual fund platform, you must know that the money first gets collected by BSE or NSE and is then forwarded to the fund house. So in this case, in case you're using a third-party platform, make sure that your transaction gets executed and money gets debited from your account much earlier. It could be, say, 2:30, for example, so that the BSE and NSE have the time to forward it to the fund house again. Now, one more area I'd like to cover with this NAV perspective is that many investors think that if they're doing an STP or they're doing a switch from one account, one investment scheme to another scheme within the same fund house, you're likely to get the same day NAV. Well, that's not true. So let me give you an example of many people do this when money is it's an STP, money lies in a liquid fund and gets transferred into an equity fund. So both of these transactions are treated separately. So if your money is lying in a liquid fund and you effected a switch, money goes out. It's a redemption from a liquid fund and gets reinvested into an equity fund. Now, redemption in a liquid fund is a T+1 mechanism. So there will be a redemption today. Then there will be an investment tomorrow into the equity fund. So illustrating with an example, today being 3rd of March, in case you're investing, you're effecting a switch transaction today before 3 o'clock, the liquid fund redemption NAV will be that of today. And next day, T+1, when the equity fund receives the money, you will get an NAV of tomorrow in the equity fund, which is 4th of March. So this is just a little bit of illustration on how a switch or an STP works.
Okay. So well explained, Harsh. Thanks very much for all the clarity. Next query comes in from Sagar Marotra, who writes to us from New Delhi. He wants to know if the rally in small cap funds will continue. He adds that he wants to invest in small cap funds and wants to know where he should look to invest. So basically the best recommendation for a small cap fund. Anand?
So I would say I wish I knew the answer if the rally would continue or not. As it is, I would say that, look,
I'm sure he means directionally speaking, not down. We're not going to pin you down to the date.
So I would say, look, from a long-term perspective, small cap funds always give a alpha compared to large cap funds. So if your risk appetite is there, your financial goals support it, and you are investing for a long period of time, it really doesn't matter whether, in the next few days it goes up and down. If you're worried about the market volatility, there are lots happening, including, the Russia-Ukraine war, the impending Fed interest rate increase. I would say the best way, if you feel you want to get an alpha and, small cap funds historically have given it, is to try an SIP or an STP. And the two funds that we like are, I would say, Access and Kotak small cap. They are really good funds. So you can start in that, do an SIP or an STP, and, I think you will make money over a period of time.
Okay, well, so that is true that over the long term, everything equalizes, right? All the volatility. But do remember, small cap funds meant for those who can digest higher risk and higher volatility. Kamlakant Raul has sent an interesting question to us from Surat. He says, considering the present scenario, he wants to know if he should stop SIPs and schemes which have exposure to foreign stocks. He would also like to know if the foreign investment limit will increase in the coming days. So basically, the mutual fund industry has hit its limit of $7 billion of investing overseas. And for now, while some of the funds may accept money of ongoing SIPs, some have stopped that as well. They cannot further invest it abroad. So Harshvardhan, what should the answer be? I mean, we don't know if it's going to happen. The increase will come in the next 1 month, 2 months, 3 months or longer. As well, the percentage of the increase, right? Will it be meaningful or not? So for an investor, what is the right thing to do? Should they continue waiting or deploy that money elsewhere? I mean, now even direct stocks is an option.
That's correct, Sumera. So if you look at it in two perspectives, there is one kind of a scheme, which is a domestic Indian equity scheme in which there is a foreign international equity allocation as well. So it could be just a regular equity fund, not an international or pure international fund, but it has international equity exposure as well. So, in those kind of schemes, if you see, essentially the allocation in international equity would be in the range of, say, 5% to, say, 30%. Now, especially in schemes which has a partial allocation to international equity, most certainly you need to continue with your investment because the fund that has been collected by the scheme gets deployed in Indian equities at least. I mean, there is nothing to say that they cannot deploy that money elsewhere. Yes, if their allocation was, say, at 25%, that could possibly reduce temporarily to, say, 20% or lower, depending on what is the inflow of funds into the scheme. Nevertheless, I don't think it's alarming enough for an investor in such schemes to stop. Now, there is also one, possibility of certain schemes, pure international schemes, accepting further, continuous SIPs, which have been already registered. Fresh investments, fresh SIP registrations have stopped. Well, in that case, what would happen is that the fund is currently then sitting on a substantial amount of cash. Now, as and when the limits are revised, which SEBI and NC are anyways in coordination with RBI, and there has been some kind of news report saying that RBI is considering a 25% increase in the limit. Now, how substantial, how meaningful would that be? It's another question altogether. We'll have to wait for the final approval of RBI for that matter. I wouldn't suggest that you should stop any SIP at this juncture. Wait for some more time. I'm very sure that RBI will come out with certain guidelines, which would be reasonably meaningful. I would not know whether 25% is good enough or not, but let's just wait. So, to sum it up, I don't think there's any reason for any investor to stop their current SIP in a domestic equity fund with an international exposure or a pure equity, international equity fund.
In any case, it's only been a month right now. I guess, better to wait it out for a little more while and then see. Anyway, we're going to take a very quick break. We have more queries to answer and our guests will stay on with us. But all of that is when we return after this quick break. Stay tuned. Hi, welcome back. You're watching MF Corner. Still with us, we have Anand Dalmia of Wisdom and Harshvardhan Roongta of Roongta Securities. So the next question that we have comes in from S. Ramakrishnan, who writes to us from Chennai. He wants to know why debt funds are offering poor returns currently and where should one invest the money which they would have ordinarily put in a medium-term debt fund. So Harshvardhan, there's no income in fixed income currently. So what are the options for an investor?
Yeah, you're right, Sumera, absolutely right. I mean, it's been a disappointment for all those debt scheme investors, wherein the kind of returns that they've got is really dismal. I mean, we've been talking about beating inflation, etc., but I don't think this has been serving the purpose. And the unfortunate part is that even if you look at if you have an outlook of the kind of returns that a debt scheme investor could get over the next 3 to 4 years, my estimation would be in the range of about 4 to 6%. I mean, so that is what you're essentially looking at from your debt investment. Now, what are the options available for a medium-term investor? I mean, who's looking to pass his money for say 3 to 4 years time horizon? Well, there are two options that you could consider. One is a product called target maturity funds, which are offered by mutual funds again. And these schemes, you could expect a yield of about 6 to 6.5%. And if you take an investment product which has a date maturing in 3 years from now, or beyond 3 years for that matter, because your time horizon is 3 to 4 years. If you're looking at that, then the taxation that is applicable on the gains that you make is long-term capital gain, which is taxed at 20% with indexation. So this is where this product scores high. The post-tax returns will be much better than what you will get on your fixed deposits and other similar products. And of course, there is liquidity as well. They are listed and you can, they're open for redemption. So you can, but at that NAV on applicable that day. The other option, of course, you have fixed deposits in which you will know exactly what is the rate of return that you're getting, because the coupon will be informed to you why you're making the investment. There are a couple of options. You could consider the post office deposits, which tend to offer a return which is higher than bank deposits. Bank deposits being the other option. Or you have a third option, which is the corporate bonds. I mean, the FDs rather, offered by highly rated AA or AAA rated companies. The overall return estimation in the band would be about 5.5% to 6.7%. So these are the two essential kind of options available. In the fixed deposits, interest, etc., the taxation would be as per your tax plan. So it might be a little inefficient and illiquid at that point.
And do remember, these recommendations are for investors who were otherwise looking to make a fixed income investment, right? So this is the alternatives for those. Sandeep Patil has written to us from Indore, and this is a very important query actually. He says his bank's relationship manager is pushing him to convert his mutual fund holdings into PMS, Portfolio Management Services. He adds that he is skeptical because he's due for retirement. He wants to know if this is advisable for somebody who's looking to retire in the next 6 years. In fact, this is a query I have received from very many quarters. Even younger people are asking this question, some not even understanding the difference between mutual fund and PMS, but being pushed to opt for PMS. Anand, what would you say?
Look, generally PMS is aggressive equity. And someone who is nearing retirement, what we would do is we'll start converting his equity and move more and more towards debt for a better asset allocation. So without getting, or without having more details around what exactly this PMS is, because firstly, in most of the PMS now there is no lock-in, but there's an exit load that most of the fund managers create if you want to take your money out early. So I don't think it's a great idea if you're 6 years before retirement to look for a PMS, and in the current market environment for you to get more aggressive with equity. I would say, in fact, if you want to invest more in equity, mutual funds or probably hybrid mutual funds are the right suggestion for you. And if you have all allocation in equity, it's time for you to start moving towards debt mutual funds, so that as in when you retire and you need cash, you're not dependent on the market condition at that point of time, and you can redeem some money from your debt funds and take care of your expenditure. So without getting more details, I think it's not a great idea.
See, there's no doubt that a lot of the PMS guys have done very, very well. The only point of contention here is that the investor must know what they are getting into. It is, it may be a viable option for many, but it may be a much riskier option than mutual funds for retail investors, and especially, for somebody like Mr. Patil, who's closer to retirement. I mean, this is the exact opposite of what advisors would tell you, which is to, like Anand said, de-risk your portfolio closer to retirement, not increase the risk. Okay, Jaideep Sarkar has written to us from Bengaluru. He wants to know if the Mire Asset Mid-Cap ETF is any good, considering that they are charging just 5 paise, or is the same ETF, which is being offered by NAV, a better bet? Please advise. So cheaper, just because it's cheaper may not mean it's too bad. Harshvardhan?
Yes, Sumera. So in fact, this is another situation where we see that just because a person is charging you less, you tend to doubt the intention of the of the company again. So well, if I was to just explain what this ETF does, so it's a mid-cap index ETF, which will aim to replicate the Nifty 50 mid-cap index. So all the 150 companies forming a part of the mid-cap index will be replicated and invested into this ETF. So the fund manager really does not have too much to do in this case, wherein they're just simply going to pick the same companies in the same proportion as they are a part of the index. So obviously, less the efforts, lesser the cost. Besides being ETF, of course, the costs come down much further. So hence the the cost of 5 paise, wherein if you invest into this, the fund management fee in that or total expense ratio will be 5 paise. As far as the comparison between, say, Navi and Mirai is concerned, I would say at this point in time, you will find Mirai to be a much better fund house in terms of the presence, in terms of credibility, etc. if you were to compare it with Navi right now. So merely because they're charging 5 paise as a TER, I don't think there is anything to doubt the intention. You may most certainly go ahead and invest into this.
In fact, the lower cost is the real benefit to an ETF investor, right? Okay, the final query today comes in from Ashok Jain. He has written to us from Mumbai. He wants to know which hybrid fund is best for investing currently. He also wants to know that considering funds, different hybrid funds are managed differently by different fund houses, is it advisable to invest in more than one hybrid fund? Very, very good question, Mr. Jain, and I'm glad to see this level of sophistication coming in to retail investors who are wanting to know about styles of management of a fund. So Anand, what would you say?
Look, I think hybrid funds are really probably one of the best categories for people to invest in mutual funds, given that they provide an asset allocation. As you rightly pointed out, there are various categories of hybrid funds. They're conservative, aggressive, and the more popular called the dynamic ones, which is the balance advantage funds, which is more normally known by that category. So I would say that for a person who wants to get an asset allocation, hybrid funds is the way. Should we invest in more than one? I would say yes, so that you can get a variety. And which are the ones that we like? I would say we like an iPru or a Edelweiss balance advantage fund, because we believe that just gives the flexibility to the fund manager to manage the asset allocation or the various instruments, debt, equity, etc., depending on the market situation. So he's dynamically managing it for you. So maybe you should go for an iPru balance advantage or an Edelweiss balance advantage, or a proportion of both of them to invest your money.
Okay. Anand, Harshvardhan, thank you very much for joining in and for advising our viewers. With that, we're going to wind up on MF Corner for now. Do stay tuned. Closing bell joins you next.